As future stewards and fiduciaries of the corporation, at this point I imagine you're beginning to wonder who you really owe loyalty to: the directors and officers of the corporation, the shareholders, or the corporation itself. And if you owe a fiduciary duty or a stewardship obligation to the corporation, just exactly what does that mean? Who are the stakeholders? If you owe a duty to those stakeholders, what does that also mean? And who is it that you need to serve? I'm kind of hoping we're going to be able to answer some of these questions for you in your new roles as corporate compliance professionals in risk management or as outside advisors to the corporation. As you'll recall, the regulatory legislative structure still holds on to the concept of shareholder primacy as a dominant Anglo-Saxon corporate governance and financial reporting model. But one of the readings that you have talks about the myth of the shareholder ownership. It's what critics call the most stubborn and damaging myth in business, that shareholders actually own companies. As a couple of law professors argue, the law provides a surprisingly clear answer. Shareholders don't own the corporation, which is an autonomous legal person. Directors' fiduciary duty is to the company, not to shareholders. Shareholders own shares, which give them residual cash flows and the rights to cash flows, and to vote on resolutions and the board elections at the shareholder meetings. And you know how difficult it is to vote your proxy at a shareholder meeting, and how many people who own pension fund investments actually get those proxy statements so they can vote within their mutual funds that they own. Shareholders have no ownership of company assets, which are really owned by the company. They don't even have an unqualified right to dividends. The most valuable company in the world, for example, Apple, rich enough to buy the Eurozone, has never paid a dividend in its life. This was as of 2012. Shareholders, say Charles Handy, our most eminent business philosopher, no more own companies than a punter on the 2.3 at Tadcaster owns the nag he is betting on. Of course, this is the British perspective. So, given that, let's take a look at Pradseeka's article, and it's one of many articles written over the last 10 years about the myth of shareholder ownership. The primacy model is dominant in Anglo corporate governance and financial reporting, even though it is considered dysfunctional and a source of crisis. And I think this is really telling what Pradseeka talks about in terms of the impact of the corporation on the average person's life anywhere in the world. Because as you remember, the top 2,000 global companies produce more than 50% of the gross domestic product of the world and employ 87 million people. People's life chances are shaped by corporate control of food, water, electricity, medicine, air, savings, jobs, news, investments, credits, pensions, and much more. Corporations run prisons, schools, roads, trains, universities, nuclear sites, defense establishments, and services which were once considered to be the domain of the state, parliamentary debates, and public choices. Corporations also profit from their involvement in tax avoidance, bribery, corruption, frauds, money laundering, and exploitation of employees, consumers, and the environment. Seek goes on. I think it's important to recall some of these things that he talks about. Far from being assured, the stakeholder primacy model continues to be dysfunctional. For example, in agency theory, traditions, the interests of managers and shareholders are supposedly aligned through performance-related remuneration of executives. But performance-related pay has contributed to excess risk-taking by rewarding short-term expansion. And continues, shareholders seek enhancement of their wealth, so their fiduciaries, their faithful stewards, must likewise seek enhancement of shareholder wealth. If maximizing cash flow potentials is shareholders' focus, it must be the focus of the stewards as well. The debunking of the shareholder primacy model is a necessary precondition for the transformation of corporations into institutions which can serve the needs of stakeholders in a broader society. And this is what Seek's article talks about. And in fact, he continues to discuss actually an incredibly important issue regarding the time that shareholders actually own the stocks. The preceding section, this is Seek, at best, shareholders have a claim to a future stream of income generated by corporate operations, which does not make them owners of the corporations. The data from the London Stock Exchange, one of the world's largest stock markets, shows that around £5.3 billion is spent every day on an equities trade. However, most of the stock market transactions are between buyers and sellers for shares already in circulation, and none of the monies go directly to the companies to enable them to invest in productive facilities. Furthermore, Seek argues, historically a very small amount of new finance for direct investment in production has actually been raised from the stock markets. And he takes a look at a study done over a 5-year period in major countries and notes that only about 1% of the gross domestic product includes new companies that have been floated on the stock exchanges. And remember, more than 50% of the GDP of the world is generated by only 2,000 publicly traded companies. What's tremendously interesting is the amount of time that a shareholder today actually owns stock. Seek argues that the duration of shareholding in major U.S. and U.K. companies has fallen from around 5 years in the mid-60s, about 50 years ago, to around 2 years in the 80s. At the turn of the century, it reached over a year. By 2007, had fallen to 7.5 months. And Seek notices the average duration of shareholders in the U.S., the U.K., and European banks fell from around 3 years in 98 to around 3 months in 2008. Banking became quite literally quarterly capitalism. The shareholding period is likely to shrink further, as Seek remarks, as in the area of automatic computer trading, the average time for a stock held before being traded is 22 seconds. And Seek notices that a time horizon of 22 seconds is not compatible with any neoliberal claim about the ownership of companies. We've also learned that with high-speed microcomputer trading today, the average time in milliseconds that a shareholder owns stock is now about 27 seconds. And this was corroborated by the New York Stock Exchange, which noted even 3 or 4 years ago that the average time a shareholder owned stock was only about 3 months. So compare the 3-month ownership of stock against the 3-year in general stock compensation option plans of executives, and suddenly the turnover of shareholders in that 3-year period is 12-fold. So effectively, when the stock compensation or the stock options become available to the executives, the people that own the stock at that time have absolutely and had absolutely no say-so in the compensation plan of the executives. Seek also notices something else, another phenomenon that's occurred because of the lack of trust in the markets by the average citizen. Despite prolonged efforts, including privatizations and tax concessions, the percentage of shares held by individuals has declined from a high of 54% in 1963 to 12% in 2014. Individual shareholders are now more dispersed than before, but the institutional investors, insurance companies, pension funds, unit trusts, investment trusts, banks, and other financial institutions hold 30% plus of the issued share capital of companies quoted on the London Stock Exchange in 63, and by 2014 also had declined to about 28%. So what's tremendously interesting is the primacy model of the shareholder is a myth, and the ownership time may be as low as 22 seconds. So let's talk a little about what you will need to ask as a risk management executive, a corporate compliance executive, or if you're working within the corporate counsel department of your large multinational global firm. Linkletter's a great English international law firm created an outline, which they call Outline for Legal Perspective on an Annual Board Statement of Significant Audiences and Materiality. And I think these are the types of questions as a fiduciary and steward within the corporation or as an outside advisor that you're going to have to contemplate and consider and ask the C-suite executives or the board or your bosses within the postmodern capitalist corporation. Let's go through some of these because I think they're critically important. They also present a perspective that is not generally looked at in the United States or not generally discussed. Setting the legal landscape. Linkletters. Briefly explain the broader legal landscape regarding the obligation that a company has to its stakeholders or with regard to its impact on stakeholders, and in particular, whether its primary duty is not to shareholders over other shareholders. Another question which Linkletters raise, did incorporation or listing historically, or does it today, require any recognition by the company or its directors of a duty to society, an obligation to take account of the company's social or environmental impact or respect of its shareholders and stakeholders? Now, we're going to talk a lot more about reputational capital and the other 6 capitals that you're going to need to really contemplate as a corporate insider. But these are interesting questions that are generally not raised in the United States. And it's interesting that Linkletters uses the term stakeholders as distinct from non-shareholders and from shareholders, in that it encompasses both material audiences, that is, providers of financial capital, of debt and equity, as well as significant audiences, which are non-financial stakeholders, such as employees, customers, suppliers, communities, contractors and subcontractors, regulators, and others, some of whom may be material to a firm or an entity or at the entity specific level. I have never seen this raised within the U.S. corporation. I've never seen it in 10Ks or management discussion and analysis, especially the significant audiences which talk about the communities or the contractors and subcontractors. In terms of directors' duties, we discussed the Model Business Corporation Act and directors' duties, but we didn't discuss them from the perspective that Linkletters looks at it. Who are directors' duties generally owed? More generally, are directors required or permitted to consider the company's impacts on non-shareholders, including impacts on the individuals and communities affected by the company's operations? Is the answer the same where the impacts occur outside the jurisdiction? That is, when we outsource in the supply chain construction or development or manufacturing to third world countries, are we responsible for the employees down this or the non-employees down a supply chain that we contract with? Can or must directors consider such impacts by subsidiaries, suppliers, and other business partners, whether occurring inside or outside the jurisdiction? Another question that Linkletters asks, which you may ask within the corporation when you're working there, if directors are required or permitted to consider impacts on non-shareholders, to what extent do they have discretion in determining how to balance different factors, including such impacts? What additional liabilities, if any, do the board or individual directors assume in exercising such directives? A couple of other questions from Linkletters, and these are fascinating because these are not questions often asked in U.S. corporations. What are the legal consequences for failing to fulfill any duties described above, and who may take action to initiate them? What defenses are available? Can these issues be given rise to other causes of action or regulatory routes whereby a stakeholder can exert pressure on a company with regards to its action. I suggest here that communities and non-owner stakeholders have very limited ability to impact the company. Are there any other directors' duties which are relevant to the interests of the stakeholders? In terms of reporting, this is also very interesting and not generally done by U.S. companies. Are companies required or permitted to disclose, they are permitted to disclose, the impacts of their operations, including stakeholder impacts on non-shareholders, as well as any action taken or intended to address those impacts? Is this required as part of financial reporting obligations or pursuant to a separate reporting regime? It's not required in financial reporting. It's discretionary, if anything. Please specify for each reporting route whether it is mandatory and voluntary. Clearly, in the States, it's voluntary. Do legal reporting obligations extend to such impacts outside the jurisdiction, the impacts of subsidiaries, suppliers, or other business partners, whether occurring inside or outside the jurisdiction? I don't think you'll see a note within the financials or the 10K of Apple that they employ through their supply chain 500,000 Chinese women under the age of 20 making iPhones through Foxconn. I don't think you're going to see that in an extended financial report of Apple. In terms of stakeholder engagement, a couple of questions that Linkletters asks. One, are institutional investors, including pension funds, required or permitted to consider such impacts in their investment decisions? And I would ask, are you required or permitted to talk to the pension funds and require them to consider such impacts of their investments? Then what is the legal duty of pension funds with regard to investment decisions in this regard? There are none in the States. Another question Linkletters asks, can non-shareholders address companies' annual general meetings? I don't think so in the United States. What is the minimum shareholding requirement for a shareholder to raise a question at a company a meeting? As you know, it's really difficult to provide questions for company meetings in the United States. Other issues of corporate governance. Are there any other laws, policies, codes, or guidelines or standards applied in the context of particular contractual relationships, for example, project finance, and we're going to discuss this later, or through adherence to particular sustainability principles, for example, the UN Global Compact, the OECD guidelines for multinational enterprises related to corporate governance that might encourage companies to consider in a structured way their impacts upon the interests of their wider stakeholders, including through a stakeholder engagement process. Recently, the Securities Exchange Act released about a 300-page discussion memo, 17 pages of which talked and addressed the issue of sustainability reporting. But again, this is in the discussion stage, in the exposure stage, and the comment stage. It could be years away before anything actually happens in the United States. I will add one of my perspectives, which I think does not exist in the United States, but is clearly embedded within the DNA of the Dutch corporation, and that is the Works Council. In the United States, you usually have an adversarial relationship between employee and employer. And in a lot of course, manufacturing companies you still have the union, non-union, labor negotiations. The Works Council, on the other hand, in the Netherlands, and I was part of the Works Council, included senior executives, included managers, included employees, and included employees from administrative assistants to, in my perspective, the average, editorial director or the average editor of a book or newsletter or service. And all of these people were together in a Works Council where we discussed the social responsibility to the community, the employees' welfare, the manager's welfare, and the executives' welfare. And we tried to, and in most cases did, align our goals to become socially responsible to our community, to our society, and to the employees. The Dutch also had the philosophy, which I think I mentioned, of lifetime partnership with their employees, with their customers, their vendors, and their shareholders. A totally different ethic. But what it did create was a sustainable company with low turnover and tremendous interest by the employees in doing their best and self-improving, which naturally resulted in the value creation of the entity. One minor point, though, is I had gone to the Netherlands to create the largest international legal publishing company in the world. And the first question that one of my publishers asked me was, if you become number one, Rick, what's going to happen to number two? That question was never asked in my 30 years in America. So with that, let's stop and we'll take a look next at some additional areas.